Okay, here's a big question for you. With a massive $1.26 billion backlog and partnerships with huge names like ExxonMobil and Toyota, is FuelCell Energy maybe finally on the verge of a turnaround after 50 years?
Or, is that history of losses, the constant cash burn, the dilution? Is that telling us the real story? Maybe pointing towards the end.
Welcome to the deep dive. We take your sources, cut through all the noise, and pull out the insights that really matter. Today, we're going deep on FuelCell Energy Inc., that's ticker FCEL on NASDAQ.
Yep.
We're going to dissect the fundamentals, their big strategic moves, the market forces they're facing, all using that closing price of $6.08 a share from June 18th, 2025 as our anchor.
And by the end, you should have a much clearer picture of whether this is a company truly heading for profit or if it's, well, maybe more of a story stock.
We've basically split this into two parts. First up, the core stuff. Business, management, financial.
And then part two, we'll look at market sentiment, who owns the stock, the big risks, and wrap it all up with our conclusion.
All right, let's get into it. Welcome back. Kicking off with Chapter 1, Business Analysis. So, FuelCell Energy, FCEL. Their business is pretty complex, right? Designing, making, selling, installing, even operating and servicing their own fuel cell and electrolysis platforms.
Yeah, and what's really interesting is how they actually make money, or aim to. They've got these four main streams, and it looks like a deliberate shift towards, more predictable long-term income.
Okay, well, what are those?
Well, you've got long-term service agreements, then owning and operating their own generation plants, straightforward product sales, and then this advanced technologies arm.
Ah, the R&D side.
Exactly. That's where the ExxonMobil carbon capture work fits in, for instance. It's like a contract research shop.
And that backlog, $1.26 billion as of April 25, average term 18 years. It sounds huge, but here's the thing that really jumps out, isn't it?
Mismatch.
Exactly, the mismatch. To land a big project, they need a ton of cash up front, but they only get paid back slowly, bit by bit, over maybe 10, 20 years.
Right.
It's this structural imbalance that seems to be behind their constant negative cash flow, their constant need to sell more stock and dilute everyone. Growth actually costs them cash in the short term.
It's a fundamental paradox. Like you said, building higher makes the foundation weaker, not stronger, financially speaking.
So beyond the money side, what's the actual tech?
Okay, so two main platforms, molten carbonate fuel cells, MCFC, and solid oxide fuel cells, SOFC. Their big commercial products are the SureSource power plants, different sizes and types, and then that really unique tri-gen system.
The Toyota one.
That's the showcase, yeah. At the Port of Long Beach, it makes electricity, hydrogen, and water all from one unit. It even uses agricultural waste as fuel. Pretty neat tech.
And they've been around forever, basically, since 1969. One of the oldest players in the fuel cell game. Installations on 3 continents, over 255 megawatts deployed. They even run 2 of the world's biggest fuel cell parks.
But that history, that scale, it makes you ask, why is market cap so tiny? We're talking 135, maybe $139 million. That's microcap territory.
Yeah, compared to competitors worth billions.
Right. It screams market skepticism about whether they can actually survive financially.
So boiling it down, what's their main pitch, their value proposition?
They're aiming to offer efficient, clean, affordable energy solutions. Supply, recovery, storage, particularly focused on that distributed baseload power for places that absolutely cannot lose power, like hospitals, data centers.
And the key selling points.
Fuel flexibility is a big one, run on natural gas, biogas, hydrogen, and then those special capabilities, tri-gen and carbon capture. The idea is customers can decarbonize without totally ripping up their existing business models. That's attractive, like we saw with Toyota.
And they're definitely operating where the world seems to be heading, right? Decarbonization, energy resilience.
Well, absolutely. The trends are massive. Global distributed power gen, projected to hit over $1 trillion by 2034, growing like 13.5% a year.
Yeah.
Hydrogen fuel cells, maybe $37.5 billion by 2035, growing even faster, over 21%.
Huge tailwinds. But the competition.
Intense. You've got direct fuel cell rivals like Bloom and Plug Power, plus industrial giants Cummins, Eaton moving into the space. It's crowded.
And how does FCEL look financially next to those guys, especially on profitability? Because those numbers, they don't look great.
They're stark, yeah. FCEL has negative gross margins. consistently. Think about that.
Mm.
They actually lose money selling their core product
Mm.
before overhead, before R&D, just on making and selling the thing.
Wow.
They're bigger industrial peers. They make money on what they sell. FCEL is fundamentally different in that regard. It suggests the business model or the execution is just not working economically,
And layered on top of that, you've got the whole regulatory world.
which is complicated and always shifting. Multiple agencies, technical codes, and then you get things like that recent NHTSA rule in June 25 about fuel efficiency standards for alternative fuels.
Yeah.
It just adds another layer of uncertainty.
Plus, getting into this business isn't easy. The barriers seem pretty high.
Very high. Huge upfront capital costs. We're talking $5,000 to $7,000 per kilowatt installed. Compare that to maybe $1,000 to $3,000 for traditional power systems.
Ouch.
Then there's the lack of hydrogen infrastructure, the high cost of making clean hydrogen, and just the sheer technological complexity. You need serious intellectual property.
So, do they have a competitive advantage and economic moat?
It's mixed. They have brand recognition from being around 50-plus years, sure. And those partnerships with Toyota and ExxonMobil definitely provide validation.
But no cost advantage.
Definitely not.
Yeah.
The negative margins prove a cost disadvantage. Their real defensible edge is probably their IP portfolio, 531 patents, and that unique molten carbonate tech that captures carbon while making power. That's a key differentiator.
Okay, but you mentioned a risk with that carbon capture tech earlier.
Right. Here's the catch. That key advantage, it's also a major risk. The most promising carbon capture stuff is tied up in that joint development deal with ExxonMobil. It depends on their funding.
So not entirely in FCEL's control.
Exactly. And to save cash, FCEL has paused most of its own work on its other main platform, the solid oxide tech. So their biggest long-term growth potential isn't fully under their own steam. That's a big gamble.
All right, let's shift gears. Chapter 2, Management Evaluation.
Okay, leadership. Jason Few, CEO since August 2019. He comes in with turnaround experience, and honestly, his whole tenure has been about managing this ongoing financial crisis. Lots of restructuring, layoffs late last year and again mid this year.
And they just brought in a new chief commercial officer, Mike Hill, in April 25. Seems like a push for sales, maybe especially data centers.
Looks that way, yeah. Signals an intent to really boost the top line.
What about how they communicate? Because there seems to be a disconnect. Publicly, it's all optimism, backlog, partnerships.
Right, but then you look at the financials, the losses, the cash burn,
Right.
and it's a totally different, much grimmer picture. Even employee reviews give leadership a C. It's a bit of a mismatch between the talk and the reality.
How have they been spending the money they do have? Capital allocation.
Historically, it was R&D and building out that portfolio of generation plants they own. But the latest plan, from June 25, is a big pivot. They're basically stopping most of the solid oxide development work.
To save cash.
To save cash, exactly, and focus on scaling the carbonate tech that's already commercial. It's a defensive move, trying to get to profitability faster, even if it means shelving some future potential.
And for shareholders, any returns coming their way? Dividends? Buybacks?
Nope. Clear policy. No dividends on common stock. Ever. No history of buybacks either. They even done reverse splits just to stay listed on NASDAQ.
Ouch. But wait, didn't you mention preferred stock?
Ah, yes. Here's the kicker. They do pay a regular significant dividend on their Series B preferred stock. And they have to pay those preferred holders before common shareholders see a dime.
So common stock is way down the pecking order.
Way down. It makes the common shares much riskier.
And if we look at how effectively they use the capital they do invest,
Nah.
ROIC.
It's bad. Really bad. Return on invested capital is deeply negative. Think negative 10% to almost 21% trailing 12 months. And the return on incremental invested capital, ROIC. As of last October, it was a shocking negative 40.25%.
Meaning for every new dollar invested.
They lost over 40 cents in operating profit. Growth hasn't created value, it's actually destroyed it. That's a very worrying sign.
Okay, let's dive right into the numbers. Chapter 3, financial analysis. Market cap, as we said, around $135 million. Definitely microcap territory as of June 18th, 2025.
Right, and revenue. Look back 5 years, it's all over the place, volatile. That big 67% jump year over year in Q2 25, mostly just timing issues, not a stable trend. Makes it super hard to predict future sales.
But the profitability or lack thereof is the real headline here, isn't it?
It absolutely is. Gross margin, deeply negative. We're talking minus 23, minus 24% TTM, losing money on the core activity. Operating margin, net margin, also deep in the red. It really suggests a long-term focus on just chasing growth, maybe hoping scale would eventually lead to profit, but it hasn't.
And how does that translate to cash flow?
It translates to hemorrhaging cash. Free cash flow, trailing 12 months as of April 25, was negative $173 million, a free cash flow margin of negative 161%.
Wow.
This constant negative FCF is the absolute critical point. It's why they have to keep selling shares, why investors keep getting diluted. It's the core symptom of the financial distress.
And earnings consistency, is there any pattern?
Oh, there's a pattern, all right. A consistent pattern of losses. Negative net income every year for the last decade. Negative earnings per share year after year. Q2 25 was another loss, negative 179 per share. It's unbroken.
But some balance sheet numbers look okay at first glance, right? Debt to equity looks low, current ratio looks high.
Deceptive, very deceptive. Debt to equity looks low, maybe 0.2, because the equity denominator keeps getting inflated by selling new shares, not by retaining earnings.
Ah, all right.
And the current ratio looks strong, over 6, but that's just cash sitting there from latest stock sale. It's not cash generated from operations. And given the burn rate, that cash pile will shrink fast.
So standard valuation metrics like PE are useless here because there are no earnings. What about price to sales? It's around 0.92.
Yeah, and that low PS ratio mainly just reflects how skeptical the market is. Investors see the sales, but they just don't believe FCEL can ever turn those sales into actual sustainable profit.
So if we try to value it based on future potential cash flows, using a DCF model.
Right, a discounted cash flow model. It tries to estimate what all the future free cash flows are worth today. But applying that kind of fundamental model to FCEL, well, it's brutal.
How brutal?
Our educational DCF model, based on projecting their continued cash burn, spits out an estimated intrinsic value per share of negative $39.61.
Negative.
Deeply negative. It's basically saying the business, based on its track record projections, is fundamentally destroying value, not creating it. The cash it consumes is worth more than the cash it might ever generate.
And the assumptions behind that model confirm it.
They do. You use a reasonable discount rate, the WACC, around 7.8%. But the critical input is the free cash flow projection. And for FCEL, those projections stay negative every single year in the forecast. It doesn't model a turnaround because the fundamentals don't support one right now.
Okay, let's switch gears completely. Chapter 4, Market Sentiment. How does Wall Street feel about FCEL?
It's pretty mixed, actually. The consensus rating is basically hold or maybe reduce. Not exactly a ringing endorsement.
But the price targets?
Yeah. The price targets are weirdly optimistic. Average 12-month target is somewhere between $7.30 and $9.86. That's a huge potential upside from the current $6.08.
That seems like a big disconnect.
It is. That wide range tells you analysts are really uncertain. There's no clear agreement on where this thing is headed.
And the general news flow, the media narrative?
Totally split. It's a classic battleground stock. You see bullish headlines focusing on that big backlog, the partnerships like that new data center deal with ADC, or a big revenue beat that makes the stock pop 24% in one day.
And the other side?
The bearish story hammers on the cash burn, the constant losses, the dilution, the history of almost getting delisted. It's two completely different narratives fighting it out, which is why the stock is so volatile.
What about short interest? Are people betting against it?
Oh yeah, big time. Short interest is really high, around 18% of the float. That means a significant chunk of the market is actively betting the price will go down.
And technically, looking at the chart, moving averages.
Okay, so the current price, $6.08, is actually above its 50-day moving average, which is down around $4.30, $4.80. That suggests a short-term uptrend, probably boosted by that recent Q2 report.
The long term?
Long term, it's well below the 200-day moving average, which is somewhere between $4.75 and $8.16. That signals the underlying trend is still down. So you've got this picture of a long-term bear market that's having a pretty strong short-term rally right now.
Got it. Okay, next up, Chapter 5, Ownership Structure. Who actually owns FCEL?
Well, institutional ownership isn't particularly high, and it's mostly the big passive players like BlackRock and Vanguard. Often, they hold it just because it's in an index they track, not because they're making an active bet on the company.
Any signs of active managers losing faith?
Yeah, recent filings show institutions have actually been reducing their positions overall. That suggests confidence might be waning among the professional money managers.
And what about the insiders, the execs, the directors? Are they buying?
This is really striking. Insider ownership is incredibly low, like 0.3%, maybe 0.6% combined for all executives and directors. Tiny.
Wow.
And worse, look at the trading. Over the last year, 16 insider sells, only one buy. And no significant open market purchases by executives putting their own cash on the line voluntarily.
That doesn't exactly scream confidence from the inside, does it?
Not at all. It suggests that people who know the company best aren't rushing to increase their personal stake.
So who owns the majority then?
It's highly spread out and heavily weighted towards the general public. Retail investors hold over 61% of the company.
What does that mean practically?
It means there's no large active shareholder putting pressure on management to perform. And it also means the stock price is probably more easily swayed by popular opinion, by narratives, by retail trading trends rather than just cold, hard fundamentals.
Okay, let's pull risks together. Chapter 6, Risk Assessment. Maybe a quick SWOT. Strengths, weaknesses, opportunities, threats. Starting with strengths.
Sure, strengths. They definitely have proprietary tech backed by those 531 patents. They have unique applications like carbon capture and Trigen. They've got validation from big partners, ExxonMobil, Toyota. And that $1.26 billion backlog does provide some revenue visibility, even with the cash flow issues.
Okay, weaknesses. These seem pretty clear by now.
Yeah, they're significant. Chronic unprofitability, those deeply negative margins, severe ongoing cash burn forcing constant dilution, operational inefficiencies, and they're heavily concentrated. A lot of that backlog is tied to just one partner in South Korea. That's a risk.
Opportunities. What's the potential upside?
Huge markets. Distributed generation, hydrogen, these are massive growth areas. Data centers needing reliable power, that's a big one. And generally supportive global policies pushing for decarbonization. The opportunity is definitely there.
But then the threats. What external factors could really hurt them?
Intense competition, for sure. From other fuel cell companies, from established giants, and from rapidly improving alternatives like solar and wind plus storage. And their heavy reliance on government policies and subsidies, if those change, it's a big problem.
You mentioned the macro environment earlier, too.
Right. High interest rates are a major threat right now. They're capital intensive, so higher rates mean higher borrowing costs, and it makes their projects look less attractive economically compared to alternatives. Management even blamed higher rates for project pauses last year. It shortens their runway dramatically.
And anything specific on the geopolitical or trade front?
Yes, this is really interesting and potentially dangerous for them. Those U.S. tariffs imposed back in March 25 on clean energy components, that directly threatens to push up their cost of revenue.
Which is terrible if your gross margin is already negative.
Exactly. It's devastating. Combine that with political uncertainty around clean energy subsidies, like the Inflation Reduction Act. You could get this perfect storm. Higher financing costs, higher input costs from tariffs, and potentially lower project revenues if subsidies weaken. That makes hitting profitability almost impossible.
Okay, bringing it all together. Chapter 7, Conclusion.
So let's synthesize. The bull case, the optimistic view. It hinges on their tech leadership, the patents, those big-name partnerships. They're positioned in huge growth markets, distributed power, hydrogen, data centers. They have that big backlog. They've got a restructuring plan. The hope is, if they execute this pivot perfectly, they get operational leverage, and the stock dramatically re-rates higher.
But the bear case, it feels pretty grounded in reality, doesn't it?
It's grounded in 50 years of history,
Yeah.
and a long, clear history of financial failure. It's fundamentally a story stock that hasn't delivered a profitable, sustainable business. Defined by negative gross margins, severe cash burn, surviving only by constantly diluting shareholders.
Plus the low insider ownership, the high short interest.
Exactly, and those major external headwinds. Competition, high interest rates, potentially harmful trade policies. The deck seems stacked against them based on the track record.
And that valuation piece, the DCS.
The valuation based purely on cash generation capacity is just brutal. That educational DCF model showing negative $39 per share. It mathematically reflects a business that has consistently destroyed economic value. It consumes more cash than it creates.
So the final outlook for someone looking at the $6.08 share price today.
Look, that $6.08 price is completely detached from the company's demonstrated fundamental value-generating ability or lack thereof. Investing in FCEL today isn't investing in a proven business. It's a highly speculative bet.
A bet on what, specifically?
A bet on a successful turnaround. A bet that management can pull off this difficult pivot, find huge success in new markets, fight off intense competition, and navigate this really tough external environment. All things they haven't managed to do consistently in the past. That huge gap between the speculative price and the negative fundamental value, that represents enormous risk. Which really makes you wonder, doesn't it? What does value even mean for a company like this? One that consistently burns through capital, despite having interesting tech and being in massive markets. Is being around for 50 years a strength, or is it actually a liability if you've never figured out how to make money?
Definitely a lot to chew on there. If you want more deep dives just like this one, make sure you like this video and subscribe to the Stock Analytics AI YouTube channel. And remember, members paying €4.99 a month get priority for deep dives on the tickers they suggest.
And just a reminder, as always, this analysis was put together by an AI system. It's for educational purposes only. It is absolutely not financial advice. Please do your own research or talk to a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll catch you on the next one.